waiting for lower rates is probably a bad idea because there's just no certainty.
Because the thing is, they should be here today.
Right.
With real under-the-rug data.
Yep. Welcome to Loans Elevated, the podcast that brings you the latest industry news, expert interviews, and insightful discussions that will help you stay ahead in this dynamic market. I'm your host, Broch Lassig, and I've spent years in the trenches of the mortgage industry, helping individuals and businesses navigate the complex landscape of real estate financing.
I'm your co-host, TJ Heidenreich, and together we'll cover a wide range of topics, from business strategies that skyrocket your success to mindset and motivation that fuel your growth.
All right, welcome back to another episode of Loans Elevated. This week we have a market episode, and we've got Ryan here, and for some reason we always land on market.
I know.
So hopefully we're not too doom and gloom again, but we want to dive in because there seems to have been a pretty significant shift in the path of what the market's doing, what the Fed's doing, how that's going to impact mortgage rates, what the path of the economy looks like, so on and so forth. So I just want to start. I'll talk about Fed minutes real quick just to give an intro because I think it intros the next topic that you and I geeked out on earlier today. But so the most recent Fed minutes basically said inflation is handled. Like they have slayed that dragon. It's done. They're not worried about it whatsoever. However, they say employment is concerning or worsening employment conditions are presenting themselves, and they're concerned about that. So they feel like the risk of inflation reverting back upwards is very, very low, if not non-existent, and employment could actually create more strain on the economy. And the hard thing about employment or unemployment is employers will be more reluctant to hire because there's constrained cash flow because rates are staying too high for too long. So the Fed's playing this balance. And there were a couple of indicators of that type of recessionary activity in this market report from the Fed minutes, which said this was speaking directly about small businesses and employers and how that relates to employment. So there were a couple things that I pulled out of there, which was low pricing power, which means these employers don't have the ability, or these companies, don't have the ability to increase prices, which is good because that's helping with inflation, right? So it's not inflationary. However, the challenge is they can't increase prices, yet they need to maintain profits for their shareholders. So how do they do that? Well, what they say is it's code word. They need to increase productivity. So what does that mean? If you have low pricing power and you need to increase productivity to boost the bottom line profits, well, that means you have to lay people off, and the people that you keep employed have to do more. Or cut hours, exactly.
Yeah, which is happening.
They have to operate more in less time. Yeah. So all of this is leading to a worsening employment picture. The Fed is seeing it. But now we go into like the challenge, which is the unemployment data we just got. So talk about September's report.
Yeah. So I think the net number of job growth in September's report was 254,000.
Yeah.
Now, how that got to that number is kind of a miracle, I would say, from the data that we just looked at. So 785,000 of those jobs that were created within that report were government jobs, which seems a little
like where in the hell did
suspicious.
785,000 government workers come from? Where did they hire them?
Exactly.
785,000 government workers. That and if we netted to only 254,000,
that's what I was about to say. Is if we're netting 254 and 785,000 just came from government jobs, that tells me we lost a ton.
Yeah, we actually
private
lost
sector jobs in September.
The data is totally
which is
skewed.
What it should be based on, anyways.
It's true. Yeah.
Right.
Yeah.
And
here's one thing that's to be mindful of. If you can Google this, I don't have any exact stats on this, but we could probably find it. But it's said that a recessionary indicator is that as healthcare and government employment increases while other sectors are decreasing, that's a very good indication that you're nearing or already in a recession. And that happens through recessions as well because they need to pump up the economy somehow. Mm-hmm. But that could, I don't know, it's very interesting.
Yeah, and peeling back another layer of the onion, age ranges from 16 to 19 years old. And mind you, September, every kid is going back to school, so this just doesn't make sense. But there were 230,000 jobs created from people within that age range, from 16 to 19. In the month that they go back to school. Again, seems a little interesting.
Well, and here's the other crazy
thing. And that
thing.
is the entire net, almost the entire net job growth in September.
Yeah, it was just that 16 to 19-year-old. So it's like,
right.
And then all of these tiny little variables in different age groups, different sectors of the economy, so on and so forth, is what brought that down from government workers and 16 to 19-year-olds. Combined
so
was
essentially, you take those two out, and we lost a ton of jobs.
Tons and tons
from
of jobs.
the people that really make up the bulk of the economy.
Well, and here's the weird thing. This is crazy. So seasonal adjustments, you would imagine, that, and that's what you're talking about as well. There should be seasonal adjustments for the government workers with school teachers going back to work because, you know, obviously if they're going back to work, that isn't a job creation. That just means they're now done with the summer break and they're going back to work, but it's not a legitimate job creation. The seasonal adjustments were like almost nothing, like 20,000. I don't remember the exact number. I wish I had it, but like 20 or 30.
The lowest in 48 years.
Yeah, the lowest seasonal adjustments in 48 years, and it was only like 20 some odd thousand of the. Oh gosh, I can't remember. 2.2 something million in education. Mm-hmm. Only 20 some odd thousand had that seasonal adjustment. It's like it doesn't even make sense because it's not like we hired 2 more teachers per classroom or something ridiculous.
Right.
You know, it's insane.
Right.
And then the other thing that I wrote down on this same topic is something that we all have to be continually mindful of. Last September, there were huge revisions downward, and it was a very similar report last September. Same kind of thing happened. So we think there's a flaw in the data, but also look at the whole year. So from this was announced a couple of months ago. We mentioned it here on the show maybe a couple episodes ago as well. But from April 2023 to March 2024, so that 12-month period, they revised the numbers of these of the non-farm payroll report downwards. So job creations, they revised down by 818,000, or in other words, 68,000 per month. Like
just a 30-something% overstatement.
Insane.
Yeah.
Like it's wild. Oh, and then one other thing that was crazy too, and this could have many economists are saying this could have a huge impact on this data, on this particular report, among these other things, but the participation rate was like way lower than we've seen in at least the past like 12 or 13 years. Participation rate was down by 2011 was down by like 15 or 20% lower than any other report in the past like 11 or 12 years. Mm-hmm. And what that means is people that are actually participating in the survey of the data that creates these reports. So if you're getting a very limited survey response, then the data is not going to be as accurate.
Right.
So anyway.
Yeah. Well, and another thing that I've just kind of collected is I've watched, just seeing news articles and things like that, and just seeing other economic updates. Big companies, which recessions, this kind of always happens. The companies that have been struggling behind the scenes are kind of exposed, right? Mm-hmm. As soon as we get into recessionary-like environments, those are the companies that really start to shut down, lay off, close doors. So Walgreens, for example, has closed 1,200 locations, or is planning to close 1,200 locations.
Dang. Wow.
Family Dollar closed or projected to close 600 locations. CVS projected to close 300 locations. You got Foot Locker, Macy's, Walmart, Applebee's, Fridays, Denny's, which a lot of these companies are probably due for some closing. But again, it's because we're reaching that point of the economy where we are hitting a recession, and I think at least in our eyes. Mm-hmm. And these are the type of companies that get exposed. I mean, they're caught with their pants down because the economy isn't great. You can't just, you don't have the stimulus. You don't have the low federal funds rate to kind of work yourself through struggling times. So it's really exposing you.
And the weird thing is there's conflicting data. So the Fed says one thing in their minutes. A couple weeks later, we get data that kind of contradicts what the Fed is saying. I feel like the Fed is probably seeing data that's maybe a little bit more reliable than what we're seeing as just the public, like in this non-farm payroll report from the Bureau of Labor Statistics. And I think we'll probably see downward revisions like we've seen for the past 1-2 years that are very, very, very significant. Like it's like false information. This type of egregious miss on stuff should be illegal. You know what I mean? Like a private company.
Well, if anything, they should be forced to come out and publicly announce and give the markets a fair chance to react to that data instead of just brushing it under the rug.
Can you imagine if a private company falsified their profits by 30 some odd % and their stock boomed because of it? Literally, people would be in prison.
They didn't tell anyone a month later and then revised it and just were like, hey, keep that quiet. We're just going to, send out a piece of mail that people are likely not going to see.
It's insane. So anyway, that's a little crazy. A couple other things I wrote down that we've been seeing as data points in the market that it's just like, what is actually going on? So what we're seeing is 2 recent reports where consumer spending is going up significantly and consumer sentiment, in other words, their opinion on how they feel the economy is going and how they feel like
about spending that money.
Exactly, about spending the money is going down. So they're feeling less confident, yet spending is supposedly going up.
It's because they're financing it.
100%. That's the next point. If you look at credit card debt reaches a new high like every single month, a new high. And it's like, okay, well, consumer spending goes up. A bunch of people have part-time jobs, a bunch of supposed government workers, all of this weird stuff. It's like, no, what's happening is there is a house of cards that is being made out to look like we're in a very strong, solid economy. Mm-hmm. Like someone's going to get smacked upside the head. All of us are.
Well, on the consumer sentiment note, I think it was the day before the jobs, or not the jobs, I'm sorry, the consumer spending was released. I can't remember the exact statistic, but they were talking about projections with what percentage of these loans are going to start going delinquent, and it increased dramatically.
It's insane. Like besides mortgages, every category is
way more than expectations.
Well, and it's every category, if you look at delinquencies, are nearing or maybe even at like the Great Recession era. These are big issues, and no one's talking about it. Like there's this smoke and mirrors, like there's no big deal. We'll see after the election. Maybe some of this goes away, and we see some legit information or clarification on data, or maybe economists just start speaking the truth. Because, like from our viewpoint, and we're just mortgage guys, but from our viewpoint, things don't look super strong. And I guess I'll just close and then give you a chance for any closing thoughts.
We're in the trenches talking to these people too, by the way.
Oh yeah, that's a great point.
We're in the trenches talking to people about their finances.
3 clients this week called me and said, I need to refinance. I know I have a really good rate. One client has like a 2.5% 15-year fixed mortgage. Mm-hmm. They're willing to let that go to refinance and relieve some of the burden on a monthly obligation standpoint because they're feeling the pinch. Like we see it in a micro way that consumers are feeling a pinch. And that has to do with people here in Utah, which historically and currently is one of the strongest economies, most employed economies.
Top 3 always, ever in the nation.
Forever. Exactly. Yeah. It's crazy. But what this means is mortgage rates could, unfortunately, remain elevated because the market, to Ryan's point, is reacting to headline data. The headline data is saying, oh my gosh, consumers are spending like crazy. So what are they going to do? They're going to sell out of the bonds, which support lower mortgage rates, and they're going to put that money back into the stocks of the companies that are selling a bunch of stuff to these consumers, supposedly. So that's happening. You've got the employment looking much better. That gives the economy, or the markets, I should say, the confidence that the confidence in the economy, and the idea that the Fed will not be dropping their rates as consistently or as aggressively as otherwise thought. Mm-hmm. So there's this stuff that is causing mortgage rates to elevate since the first Fed rate drop. And honestly, from a fundamental perspective, looking worse. Like we could see rates stay higher for longer on the mortgage side until this supposed house of cards falls, which we believe will happen. So just be mindful of that in your decision-making. Waiting for lower rates is probably a bad idea because there's just no certainty.
Because the thing is, they should be here today.
Right.
With real under-the-rug data.
Yep, for sure. Anything else? Cool. Thanks for tuning in, guys.
Thank you for tuning in. For more industry insights, follow us on all platforms at Loans Elevated.
And to get in touch with our team, call or text 801-713-4000 or visit loanselevated.com.